Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings to see what is really going on. Today we're diving into KKR Real Estate Finance Trust Incorporated's 2025 annual report, and let's just say this filing painted an interesting picture of their financial health with some really big swings in their numbers. If you are curious about how a major real estate finance company navigate a complex market, stick around. And hey, before we jump in, if you dig getting these kinds of unfiltered insights from financial documents, do us a huge favor and hit that subscribe button. We also have a growing community on Discord. The link is in the description below if you want to dive deeper into these discussions. So KKR Real Estate Finance Trust Incorporated, or CREF as they call themselves, is a real estate finance company. Their main game is originating and buying loans that are backed by commercial real estate properties. Think big office buildings, apartment complexes, that sort of thing. They operate as a real estate investment trust, or REIT, which is a tax thing that means they generally don't pay corporate taxes if they distribute most of their profits to shareholders. Now, CREF stock is traded on the New York Stock Exchange under the ticker CREF. As of mid-2025, the market valued the company's freely traded stock at around $478.8 million. That is a pretty significant number, and it tells us investors were watching them closely. Like most companies, CREF starts its reports with a strong dose of caution about forward-looking statements. They're basically saying, hey, we're going to talk about our hopes and plans, but things could change, and the actual results might be very different. It is a standard disclaimer, but it's always worth remembering that these are projections, not guarantees, and they certainly don't shy away from listing the risks. They're worried about everything from general economic conditions and interest rate fluctuations to specific real estate market downturns, and even conflicts of interest with their manager, KKR. This is a pretty long list, but the core message is that investing in real estate finance is inherently risky, especially with all the economic uncertainties out there. Let's get to the heart of their business. CREF's main strategy is to originate and acquire senior loans secured by commercial real estate. They target properties owned by experienced sponsors in top markets, and they also look at mezzanine loans and preferred equity. Their goal is to preserve capital and generate good returns for shareholders, mainly through dividends. Looking at their portfolio size, it is clear they had a substantial operation by the end of 2025. They reported a total investment portfolio of nearly $6 billion. This is up significantly from previous years, showing growth, but it also means more risk. Their common book value, which is basically their net worth to common shareholders, stood at a solid $844.8 million. However, it is important to note this includes a significant allowance for credit losses, almost $204 million. This allowance jumped quite a bit from the previous year, signaling concerns about the quality of some of their loans. How do they fund all this? CREF uses a mix of equity and debt. They've been actively expanding their non-mark-to-market financing, which is basically debt that doesn't get its value adjusted based on market ups and downs. This is good because it protects them from sudden market drops affecting their borrowing costs. They've got billions in these kinds of facilities, which is crucial for stability. The details of their loan portfolio are pretty extensive. As of the end of 2025, they primarily held senior commercial real estate loans totaling over $5.3 billion. A significant portion of these loans, about 58%, were tied to multifamily and industrial properties. Geographically, California, Texas, and Massachusetts were the top states where their loans were concentrated. They also have substantial investments in real estate, owned assets, which are properties they've taken back through foreclosure or deed. In lieu, these REO assets totaled over $500 million, a big jump from the previous year, which usually indicates a tougher environment for borrowers. Let's look at some table highlights. The total outstanding principal for senior loans was over $5.3 billion. Notably, almost all of this was on floating rates, which is good in a rising rate environment, but can be a concern if rates drop significantly. The weighted average loan to value, or LTV, at origination was 66%. That means, on average, the loan amount was 66% of the property's appraised value at the time of the loan. Lower LTVs generally mean less risk for the lender. They also had about $74 million in fixed-rate loans, which may become less attractive if rates fall. Now, for the income statement, it is a bit of a mixed bag here. In 2025, CREF reported a net loss attributable to common stockholders of almost $70 million, or a loss of $1.05 per share. This is a significant drop from a profit of about $13 million in 2024. The story here is a huge increase in their provision for credit losses, which jumped by almost $39 million compared to the previous year. This is the money they set aside to cover potential loan defaults. When this number goes up that much, It is a big red flag, suggesting they're seeing more loans going bad or becoming riskier. That provision for credit losses is a critical number to watch. It jumped from about 80 million in 2024 to nearly 119 million in 2025. This sharp increase, especially on their riskier loans, is a major driver behind the company's net loss for the year. Their net interest income, which is the difference between the interest they earn on loans and the interest they pay on their borrowings, also saw a significant drop. It fell by about $39 million from 2024 to 2025. This is likely due to a combination of factors: a smaller loan portfolio because of repayments and write-offs, and lower average interest rates on some of their loans. Let's talk about their liquidity. KKR has over $84 million in cash and cash equivalents. They also have significant borrowing capacity through their revolving credit facility, which has $700 million available, and other financing arrangements. They've also been actively extending maturities on their debt, pushing out when they have to pay back major loans to 2030 and beyond. This is a good sign as it gives them breathing room. Overall, their liquidity position seems decent, but that allowance for credit losses is definitely something to keep an eye on. Looking at their balance sheet as of the 31st of December 2025, their total stockholders' equity was about $1.17 billion. However, remember that preferred stocks have a claim on assets before common stockholders. After accounting for the preferred stock's value, the common stockholders' equity was around $844 million. This is down from over $1 billion in the previous year. The drop is mainly due to the net loss for the year and share repurchases. The notes to the financial statements dig into the nitty-gritty, and a key area is their allowance for credit losses. They use a complicated model called CECL, or Current Expected Credit Loss. This means they have to forecast potential losses, not just react to them after they happen. The report details how they adjust these estimates based on economic forecasts and specific loan risks. The big increase in the allowance for credit losses in 2025 was largely due to setting aside more money for loans that are considered riskier, particularly those with a risk rating of 5 out of 5. When a loan is considered impaired, KKR has to value the property backing it to figure out how much they might lose. This valuation process is really complex and relies heavily on estimates of future cash flows, discount rates, and leasing assumptions. Given the subjectivity, it is no surprise that this area is a critical audit matter for their auditors. This valuation process directly impacts how much they reserve for potential losses. The fact that their real estate-owned assets, property they had to take back, significantly increased, especially those held for sale, tells a story. It suggests they did have to step in and take over some properties, likely because the original borrowers couldn't make their payments. While they did manage to sell some of these properties for a small gain, the overall trend of increasing REO assets usually points to a challenging market. KKR also consolidates entities they have significant financial interests in, like certain CMBS trusts. In 2025, they consolidated a CMBS trust with assets worth over $500 million, meaning those assets and their liabilities are now on KKR's books. They elected the fair value option for these, which means changes in their value are reported directly in their income, adding another layer of volatility to their earnings. Overall, KKR's financial performance in 2025 was challenging. They posted a significant net loss, primarily due to a substantial increase in their allowance for credit losses and a decline in net interest income. While they have strong liquidity and access to credit facilities, that growing allowance for credit losses signals potential headwinds. Their strategy remains focused on originating transitional senior loans, but the increased REO assets and loan right off suggest they are facing difficulties in this area. The heavy concentration in certain property types and geographies, while diversified to some extent, could also amplify losses if those specific markets or sectors face downturns. And of course, there are the risks related to their external manager, KKR. The filing details potential conflicts of interest, especially around allocating investment opportunities and fees. While KKR is a reputable firm, it is always something to watch when a manager can potentially steer the best deals to its own funds rather than to KKR. So what is the takeaway here? KKR is navigating a really tough market. They've grown their portfolio significantly, but that growth has come with increased risk, as evidenced by the huge jump in their credit loss allowance and the net loss for 2025. The increasing amount of real estate owned assets is a concern, suggesting some of their loans are in trouble. While their liquidity and financing seem solid for now, the future hinges on whether they can manage these credit risks and the broader economic environment. They're relying heavily on KKR's expertise, but the conflicts of interest are real and could impact shareholder value. It is a complex situation, and investors will need to carefully monitor how those credit loss provisions evolve in the coming quarters. This filing shows they are facing some serious headwinds, and the path forward will demand very shrewd management. Alright, that is our breakdown of KKR Real Estate Finance Trust's 2025 filing. What do you think about these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If you found this analysis valuable, hitting that like button really helps us out. And of course, subscribe for more deep dives into corporate finance. And remember to check out our Discord channel in the description if you want to keep the conversation going. Thanks for watching, and we'll see you next time on Corporate Decoder.